Ladies and gentlemen, good day and welcome to Relaxo Footwear Limited Q4 FY23 earnings conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Junjunwala from Elara Securities Private Limited. Thank you, and over to you.
Good evening, everyone. On behalf of Elara Securities India Private Limited, I would like to welcome you all to 4Q and full year FY23 post-result conference call of Relaxo Footwears Limited. Today we have with us the senior management of the company, including Mr. Ramesh Kumar Dua, the Managing Director, Mr. Gaurav Dua, Whole-Time Director, Mr. Ritesh Dua, Executive Vice President Finance, Mr. Sushil Batra, Chief Financial Officer, and Mr. Ankit Jain, Company Secretary. Without taking any further time, I would now like to hand over the call to Mr. Sushil Batra, and over to you, sir. Thank you.
Thank you, Prerna. Good afternoon, ladies and gentlemen. Thank you for joining us on this earnings call for the quarter and fiscal year ended 31st March 2023. The earnings press release and the investor presentation have been uploaded on the stock exchanges as well as at our website, and we hope you have had the chance to go through these. Before we begin the question and answer, I will quickly go through the Q4 and FY23 performance, starting with Q4. In Q4 FY23, we recorded a revenue of rupees 765 crore as against rupees 698 crore in Q4 FY22, recording a growth of 10% year-on-year. On a Q-on-Q basis, the revenue increased by 12%. This is mainly due to volume growth across all categories. Our Q4 FY23 EBITDA was at rupees 118 crore, up by 6% year-on-year from rupees 111 crore in the corresponding quarter of previous year. EBITDA margins were at 15.4% in Q4 FY23 as against 15.9% in the corresponding quarter. On a Q-on-Q basis, EBITDA margins have grown substantially by 481 basis points due to selling of low-cost inventory along with costly old inventory. That was at rupees 63 crore. On a sequential basis, that grew by 110% from rupees 30 crore in Q3 FY23. That margin for Q4 FY23 was 8.3%. Our price efforts during the last quarter have resulted in a good momentum, and we have continued our market share recovery in all major segments during this quarter without relying much on discount and offers. Now moving on to full year FY23, despite the challenging environment last year, our strong team responded effectively, and our commitment to maintaining our high standard of excellence have made us successful. Revenue for FY23 was at rupees 2,783 crore, up by 5% year-on-year from rupees 2,653 crore in FY22. EBITDA was at rupees 336 crore as against rupees 416 crore in FY22. EBITDA margin was at 12.1% as against 15.7% in FY22. Margins were affected primarily by the high pressure on raw material prices during most of the year. That was at rupees 150 crore in FY23. We are now a debt-free company with robust cash flow operation due to our strong working capital management. During the year, the company incurred a capex of rupees 174 crore. With the stabilization of raw material prices, we are currently experiencing strong demand and hold an optimistic view of the future. Our company is strategically positioned to take advantage of the opportunities within the industry, allowing us to further expand our market share. Our key strengths lie in our in-house manufacturing capabilities, quality of our product, and the strong recall of our brand. We remain dedicated to upholding these strengths and will persistently strive to maintain their integrity. We have confidence that our continued efforts will yield positive outcome for us in the times ahead. Thank you. Now we can open the floor for questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ali Sagar Shakir from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity, sir, and congratulations to finally seeing a good market share trend, in your company. I have 3 questions. First is on the, current quarter. I understand from our channel checks that, post the cleanup of the old inventory, market demand has picked up quite strongly, and in fact, Relaxo has not been able to, meet all the distributor demand. So is this true in multiple geographies, and do you think we would have lost any revenue because of that factor? If you could just quantify, what could have been the impact of that in this quarter, and has that been now subsided, or we are still seeing demand not being able to fully met?
Yeah, this is Gaurav Chua. What you said is partly correct, that there is an upsurge in demand, and we are seeing it. One reason is that we have corrected the prices, and second, this is a peak season for us for open footwear. As we are 75% open and 25% closed, so this is the open footwear starting from January to June to July. So, and regarding the shortages, we are managing. We have inventory with us, and the uptake we are seeing across India for the open footwear.
Got it. So, can you quantify if you would have lost any revenue because of that in this quarter, and has that been now subsided?
It happened in February because there were some IT issues which has been corrected, and now we are able to cover. We have the inventory, sufficient inventory.
Okay, got it. Second question is on your margins. So while we have significantly reduced prices, we have seen impact on margins. So can you share, what is the trend we should expect in the coming quarters as raw material prices are also softening? So should we see that helping us, and therefore the impact on margin that we saw in this quarter should improve? How should we see that?
I'm Ramesh Kumar Dua. Market remains challenging, and we have to be very cautious with respect to our pricing of our article, so that we always have a good market share as far as sales are concerned. The EBITDA margin that you are seeing in this quarter is likely to continue, and there has likely to be some improvement also.
Got it. Thank you, sir. This is very helpful. On the gross margin also, should we see improvement because of the raw material price softening?
Some improvement, yes.
Understood. And just last question on the closed footwear in the sportswear category. I understand that we have made a lot of changes in our design team, online team. If you could share some, thoughts in terms of, what is the strategy in the sportswear in terms of the new product development, and what is the aim in the next 3-4 years? Can we expect to reach about 1,000 crores in 3-4 years time? I mean, if you can just share what is the strategy there.
So if you talk about Sparks sports shoes, we have grown heavily. We have done roughly around 25% growth, and before that, last year we put up a plant to cater to this need. So still, the plant capacity still we have. It will take 2 to 3 years to reach to that level. And you're talking about 1,000 crore. Sparks is already 1,000+ crore brand.
Yeah, but sportswear would be relatively lower, or of course, Sparks is much bigger, but within that sportswear, if you could just quantify how much would that be?
So that is roughly around, we do sports shoe and all sports category, roughly around 400 crores. So definitely we have aspiration to become 1,000 crore it will take 2 years, 3 years, time will tell.
Understood. This is very helpful, sir. Thank you so much.
Thank you. Next question comes from the line of Vikas Jain from Equirus. Please go ahead.
Thank you, sir. Thank you so much for the opportunity. For the first question, definitely we have seen a market share which we have regained from which was also earlier competitor. So at this point of time, can you easily say that we have reached almost all of the market share, or some part of it is still left?
Can you repeat the question? It's not so clear.
So I was mentioning about the market share. So have we regained the entire market share and reached to what we were at the COVID times, or probably some part of it is still more left to gain?
Yes, definitely. What we have lost market share in last Q1 or Q2 last year, we are seeing the good momentum now, and we are gaining the market share back. So definitely we will recover. We have recovered, now we'll recover more.
Sure. Okay. And so second question with respect to the demand, well, Ramesh sir did mention that the demand environment continues to remain challenging. So probably, is it like how would you, some comments with respect to how is the underlying market growing, and what do you think it will take for the market to normalize, in what time period, according to your estimates?
So actually what we are hearing from the market, that this Eid and this festive, there is a demand contraction happening in some parts of India. Rural India is still not able to cover up what it was contributing. But I think this is a temporary phenomenon. The inflation is now getting controlled, and we'll definitely see the uptake in coming quarters.
Understood. And then with respect to last, again, with respect to penetration in South India, so how can you broadly break our revenues across on a geographic basis? What is the contribution from the all four, North, West, East, and South region?
So North contribute maximum to around 44%, followed by East 22, 20 is West, and 15% is South. And we are maintaining this from last year. It is similar.
Sure. And with respect to more distributors adding in the South, is that on track, or how many have you added this year probably?
So it's not a great achievement in adding more distributors. We have maintained what we were having. So always there will be a churn, new addition, and some people leaving. So it's roughly around same.
Okay. So thank you so much for the offer.
Thank you. Next question comes from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah. Good afternoon, sir. Thanks for giving the opportunity. So my question is on the price cut what we had taken. So we had taken the price cut to reduce the pricing gap between the lower price, the products which are unorganized and lower price point products. But since you said that raw material prices have all corrected, have we seen any price reduction undertaken by those bottom of the pyramid players or lower price point players in the market, and because of which again the pricing difference what you were planning to reduce, it has again gone up? Any sense on that?
No, now our prices are very competitive, and there is no room for further price cut. And even our competition, while we are very competitive, there is no issue. I don't think there is any room competition can do much about it.
Okay. So you don't see any further price cuts happening in the market, right?
No, not so.
Okay. And so my second question, you have been consistently been talking about expanding your capacities. So any guidance for capex going ahead, and where you are planning to add capacity?
No, what last year the whatever capacity we wanted to expand, that has been expanded.
Okay. So there is no going to be any.
This year only money is going on molds, which are regular kinds of things, some repair, molds, and backward integration, some capital asset generation, that's it.
Okay. Any thoughts on your retail expansion plan? By FY23, how much was your reach, and where you want to take it over the next 2 years?
So earlier we were maintaining around 400. Now we are expanding this year.
Can you provide some numbers on
No, earlier we are having 400 outlets. Now we are planning to have 465 this year. 65 more addition.
Okay. Fine.
Thank you. Next question comes from the line of Onkar Gugadre from Shree Investments. Please go ahead.
Yeah, my question was regarding, it's from your investor presentation. So from FY21 to FY23, the average realization has gone up, but the number of pairs sold has decreased. So, and in this quarter, the average realization has gone down significantly, but number of pairs sold has increased dramatically. So, like, what's the management's view on this going forward? What could be the average cost of pair, or like how it is supposed to be in the future?
Last year we had done major correction in some of our categories like Hawaii, Eva. So that was the reason that now average selling price has gone down. And our volume has gone up. So that is why volume is going up, but the average rate has gone down only because of reduction in prices.
So from here on, what we can expect? A stabilization here, or like
stabilization, by and large stabilization.
Okay, you don't see any upside from here on?
On the whole year side, because in this quarter, mostly open footwear was on demand. Closed footwear comes in winter session. So overall in the year, again you will see our last year average price of 160 will be back.
Okay, so for the current financial year, you are expecting around 160 rupees per pair realization.
Could be a little high also, depending upon the shoe season. Does little better, then things will be further. But around 160, 165 we can expect average.
Okay, and what about the number of pairs? I mean, what could be the ballpark estimate for that?
Definitely, from the last year, we are expecting double-digit growth in volume for this year.
Okay, so around double-digit volume growth and around similar kind of average realization per pair, or somewhat higher.
Yeah.
Okay. As far as the ROE and ROC is concerned, what's the plan on next 2-3 years, since it has come down dramatically again from FY21 to FY23?
Definitely it will improve in coming years because last year was a tough year, profits were under pressure and we did capex also. So next year definitely it will be much better than this FY23. We can compare with FY22, things goes well.
Yeah, because it has now come down to a single digit now. That's why I'm asking.
Definitely it should be at least between 15 to 20%. That is the intent, and if things are well, so definitely we will achieve that.
Okay. As far as the demand outlook is concerned, how are you seeing currently it is shaping up?
So currently there is a little challenge in the market. There is little demand contraction, but I think going forward, Q2, Q3 onwards will be better.
Okay. In the current quarter, you are facing some demand issues.
Yeah, because what we're hearing from the market that still rural is not back on track. It's going to take little time.
Okay. Any update on what could be the export percentage, and how is there any opportunity for Relaxo, or like the home market is so large that you are not even bothered to think about the export market?
I'm attached to what is right. Exports we have done around 4.5% of total revenue, and the way we are growing last 2-3 years time, we're getting double-digit growth, and we are in future also we are expecting the same growth will sustain.
Okay, the margins over there are better than the home market, or like how it is?
It's like similar.
Similar. And which are the major countries you are exporting to?
We are exporting to all these like regions we are growing, like Gulf, Oceania region, or even Africa. Even Central America has now showing back on track, because during COVID time that was badly affected. So that also is growing now. So all markets are good.
Okay. All right. Thank you very much.
Thank you. Next question comes from the line of Ankit Kedia from Phillip Capital.
Such 11% realization drop YOY and quarter on quarter. How much is due to price cut and how much is due to mix change or new, you introduced 105 rupee chappals also in the market, last quarter. So can you give us that impact of mix versus price cut?
The lowest price article that you're talking, that is very minimal. It has no any significance. It is just entry barrier kind of an article. But otherwise, whatever price cut we could do on account of fall in our raw material prices, that we have done, and that's it. No more price cut. We are competitive and optimistic. Things are growing. We are getting our market share back.
And so in this 11% realization drop, can you quantify how much is due to mix and how much is due to price cut?
Very complicated. We have 400 articles, different pricing, different material consumption. So this is very difficult to quantify because article-wise things are different.
So is it fair to assume that the price cut in open footwear could be higher than the price cut in closed footwear if you have to take on blended basis?
Yeah. Because more polymers are required in open footwear, not the EVA and our Hawaii slippers. But in sports shoe, upper is a different material, upper bottom is different material. So you are right. In case of sports shoe, price cut was not this. It was almost same.
Understood. So the reading is the 75% open footwear we would have taken, while in closed footwear, which is around 25-30% of our business, we would have not tinkered with the prices much.
Oh, no, not much.
Understood. So my second question is regarding promotions. We have seen high promotional activity in the quarter in the market. Your competitors also in the month of January, February, March were very active by giving higher dealer commissions and even retailer commissions. So could you please elaborate, how was our promotion activity in the quarter? And going forward, how are you looking at your A&P spend?
We maintain the A&SP spend, in terms of schemes, we always, we have, depends category to category. Hawaii, we have different types of schemes. In shoe division, we have different types of schemes. So seeing the demand, seeing the market scenario, seeing the pricing, we decide what kind of scheme we have to run. And we will see the competition also. So we don't benchmark exactly. We see what is our need, and then we float the scheme. So we do not exceed, if competition is giving more, let's give more. We have to analyze other situations also.
Sure. And what is the A&P target for next year, and how much is it for this year, if you can quantify?
So, if you talk about A&SP, we do around 8 to 9%, and we are maintaining this from last 2-3 years, and we try to maintain similar pattern in this coming year also.
Understood.
So this includes advertisement also, A&SP, advertisement and promotion.
And how much would be pure advertising?
Roughly around 4.5-4%.
Understood, sir. And sir, if you can just share, you're one of your competitors in, sports shoes is going very aggressive in EBOs. While if I look at your EBO count for last 4 years, has been pretty much flat at, 390 odd EBOs. Why haven't you expanded EBOs in last 4 years? What is, the risk you see in EBO expansion, which has, while COVID years were also there in 2 years, but still the expansion has not been compared to the market, where we are seeing competitors expand EBOs. So if you can just talk a bit on that.
You're right that the last 2 years we did expand. We wanted to make it a little more efficient because we have to control our bottom line also. And our article 75% open footwear, 25% sports shoe. The competition you are comparing with their only shoe outlets. So keeping in view a balance. So the strategy of our retail showroom is to showcase our products. Share of our retail outlet in the total scheme of things is around 8%.
Right. And is it fair to assume the margins in EBOs would be just near double digit and lower than the company average?
Yeah, it's lower than company average, but I think the high single digit margin we are in the category.
Understood, sir. Thank you so much and all the best, sir.
Thank you. Next question comes from the line of Manish Poddar from Motilal Oswal AMC. Please go ahead.
Yeah, hi. Thanks for doing the call. So currently 3 questions. One is, can you help me with primary and secondary numbers for this quarter?
Can you repeat again? Can't hear you.
Primary and secondary numbers, because you are saying that Q1 is still soft, but your volume numbers, when I look at it, 5.2 versus 4.2 of last year or 4.1 of this quarter, last quarter, they seem to be doing decent. So I'm just trying to understand what am I missing.
I think it's a volume growth. So you are referring the number which you mentioned in investor.
Yes, volume growth.
We sold more open footwear in this quarter and lot of demand was there. So that's why these numbers are very high as compared to earlier quarters.
Okay. But would that be the case in the base quarter also?
Which quarter? Coming?
This current quarter, Q1 you are talking about?
No, I'm just saying when I compare Q4 FY22, where you sold 4.2 crore pairs versus 5.2 crore pairs in this quarter, the mix would be similar, right? This point which,
yes, this also I think it will be sustained.
Mix is also similar. You're right.
Mix is similar.
Yeah.
So this growth, is it the channel was running low on Relaxo products given up pricing and now it has stabilized? Is that a function of that, or is it a lot of customer offtake also happening?
No, it is like what we lost market share in Q1, Q2, Q3. Now we are regaining that market share. So we are getting the space back at shelves,
Okay, shelf space. Okay. And the second point is you are also doing pricing parity earlier. So where are we in the journey now? How is pricing across channels for you now?
Now we are very competitive. That is why we are able to get the cover shares.
Okay. And just one last one, if you could give, let's say for FY23 as a whole, just a broad brand-wise split between Sparx, Flite PU, Flite EVA and Relaxo.
Sparx is around 40%. Flite is around 50%. And rest is our Mohammed and Relaxo brand.
So Sparx 40, Flite is 28 and the rest is
38. Flite is 38.
Okay. And how much would be Flite PU and EVA in that 38?
It's 40 something.
You can say 1523 like that.
1523. And just one last one in Sparx. Sorry, I didn't catch that number.
So you were asking now the split of EVA and PU. EVA was 15 and PU was 23.
Also 38 the breakup we are telling.
Right. Just one last one. In Sparx, how much was closed in Sparx?
Total, close has been around 25%.
45%. 45%. So
I think the query is within Sparx you are asking.
Yeah, within Sparx. So let's say of this 2,800 crores you are saying Sparx is roughly 40% of sales. So roughly 1120 crores. How much is closed in that?
So closed is 40, 60. 40% is closed and 60% is open in 1,000 crores.
in this 11. Okay, so it's roughly 400 crores now. Okay.
400 to 450, yeah.
Okay, fine. Thank you so much.
Thank you. Next question comes from the line of Gurang Kakkad from Haitong Securities. Please go ahead.
Yeah, hi sir. Congrats on a good recovery in volumes as well as margins. I have two questions. Firstly, can you give the trend in terms of how the EVA prices are currently panning out? And what was the Q4 average pricing of EVA for you?
Now, EVA prices are stabilized. It was around 170. That is what, this is at what rate we consume. Although market may be at 160 only. This, the current, in the month of April, current quarter that is going on, it is around 160 rupees, 155 rupees. It keeps on changing little bit here and there.
Okay. And last quarter in the base, this would be very high, right? Closer to 250, 300 rupees. Q4 FY22?
These are 250 rupees.
Okay.
Quarter one of this year, past year, 22-23.
Right. And currently the prices are stable at around 155, 160 rupees, which is what the Q4 pricing, average pricing was.
Correct.
Okay. Okay. Thanks. And secondly, on the EBO outlet strategy, so you have been at those 400 outlets for some time now, and it's heartening to see that there is some plans in terms of expanding that by around like 15% this year. Now, is it that we've got the model right in terms of EBO and now we can target healthy margins in the business, or is it more so given that EBOs are largely Sparks brand focused, so we want to target aggressively and go aggressively on the Sparks brand? So what's the strategy out here?
Naturally, once we are having more efficiency in our stores, so we have started expanding this year. And we will continue the momentum the way things are.
Okay. So like every year you will have around 60-70 store expansion in the EBO going ahead?
We hope so.
Okay. And this high single digit margins largely is sustainable, or we can target to aim more closer to double digit, or even once it's like fully scaled up and maybe 2-3 years down the line?
Oh, yeah, naturally. Down the line, things will improve further. But we have to be always cautious, keeping in view competition, having a competitive pricing. So, but things will improve because when the sales improve, then efficiencies improve, overhead start getting low. So ultimately, your bottom line improves.
Right. Yeah, that's it from me. Thank you.
Thank you. Next question comes on the line of Jasdeep Walia from Clockvine Capital. Please go ahead.
Hello. Good afternoon, sir. Can you hear me?
Yeah.
Sir, thanks for giving me this opportunity. So my first question is...
Hello, this is the operator. Hello. Hello, this is the operator. Hello. Hello, this is the operator. Since there's no response from your end, I'm going to have to disconnect.